Well, first of all, to your first question, guys like Jeffrey Gundlach and Michael Hartnett and the CIO, Chief Investment Officer, Morgan Stanley, are not speaking to the plebes. They're speaking to institutional level traders. So they're telling the people at the top of the financial food chain, this is something you've never heard from us. So we're couching it by just calling it 60-20-20 or 25-25. Michael Hartnett's newsletter is so expensive that no one mainstream reads it unless you are a institutional sized trader or hedge fund, running a hedge fund or whatever. These people at the top level are being given the acknowledgement, the wink of the eye, if you will, by the same banks that have been suppressing the price. At the same time, we've talked at length about, and I started my first couple podcasts with you in 2020, we talked about the others that showed up on the Commitment of Traders report, which there was always just two groups of reportables. The largest positioning in the Commitment of Traders report published by the COMEX were the hedge funds and the commercial banks. Then all of a sudden there's this group called the others. Who are they? They are sovereign wealth funds. They're central bankers wearing a different hat. They're friends. They're an offshoot, if you will, or family offices of tremendous wealth start standing for delivery, which I'm like saying to you, Dunnigan, this never happens. What, less than 1% have stood for delivery my whole career. At this point, it's been 30 years I've been doing it. Something's not right. And now we see it. Of course, we've seen it with almost 40 central banks repatriating their gold from the Bank of England and the New York Federal Reserve. Early adoption into backwardation right now. We see problems of getting the metal. Sorry, there's a 8-week delivery delay, folks. We have a shortage of manpower and trucks in London, we were told. Or, not really a good example, but gets the point across. Venezuela says to Bank of England, can we please have our gold back? No, you can't. And when you see 40 countries pull their gold home from the Bank of England and New York Fed, they were there because for many years you had the Western rule of law and stable, liquid, efficient markets, the COMEX and the LBMA. They don't care. And you're seeing exchanges, the Shanghai Metals Exchange and their expansion in multi-jurisdictional expansion, one being built right now in Saudi Arabia, one just completed in Hong Kong, which allows you to take metal off of the exchange through Hong Kong and receive it directly by trading yuan into it. The people who are doing this are the central banks, and they are the most well-informed traders on the planet. That's number one. Now it's moving to the commercial banks who are telling their institutional-sized clients, early adoption is everything. And this is why most people fail at investing, because they move rather than trusting their intuition and listening to the rants of a guy like me. What the hell do I know? Or Alasdair, what do we all know? Well, we've been right. And we have been right. By hook or crook, we've been right. And, we were laughed at. And you look at an environment where Wall Street refuses to acknowledge it, but now they are at the highest level. But they don't tell you, yeah, we've been wrong. We laughed at all of you guys who wanted to buy gold and silver, yet it's outpaced the 10-year Treasury 2-to-1, doubled it. It's beaten the S&P 500 with dividends reinvested for 25 years, which, by the way, no one ever does. No one ever does reinvest all their dividends. But we are living in an environment of negative real rates, and you could argue yield suppression, where they're trying to keep the yield down best they can, monetization of assets. And this has pushed investors for a long time into risk assets, which have inflated valuations, like all the Mag 7. And it's hiding the risk. And that risk hiding, well, the insiders know. Why do you think they're leaving? As the public's chasing that FOMO. This isn't free market pricing at all. And the assumptions of return are off. You can't make these assumptions in this environment. And I think, to Alasdair's point, the one thing about having gold and silver in your hand is it is an asset that has no counterparty liability. And if you do...
first of all, when Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement, and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different, everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement, and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which is being funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that.